Hi, today we'll start accounting for share capital. This is the third lesson in corporate accounts. Accounting for share capital. Just a minute. Yeah. We should know what is meant by share. What is meant by share? Share means a share in the share capital of the company. So what is meant by share capital then? So that you can, let's just say you want to start a business and you require 200 crores, right? So you can, if you have that kind of money, you can start a business, but it's generally it's not possible to have that kind of money because it's very big amount of money, right? So you can start sole proprietorship and you don't have that kind of money also. And the partnership, if anybody if your partners are able to contribute this much of money, then you can start a partnership, or you can go to the banks. But for banks you need to show some support, some security, otherwise they won't grant 200 crores loan for you, right? So then if all these options are not for you, then you can go to the public. You can explain your idea to the public and invite them to contribute money or invest in your business. If the public like your idea, then they will invest in your company, right? So this is your company and this is the public. And for public you will give the shares, and public will give you the money. Let's just say for example you want 1000 rupees, right? So this is this 1000 rupees, we can call it as share capital. And then this 10 rupees is the face value of each share. And then there are 100 people, 100 members. You will issue shares to them in return, so they will hold the shares, so that's why they will call it as shareholders. 100 people contributed 10 rupees each, and totally you got 1000 rupees. This is share capital. You can start a business with this, right? But all these 100 people has a share in your share capital. Now you can read our definition. Share means a share in the share capital of the company, right? Okay. So these 100 members are, we'll call them as shareholders, and this 10 rupees is face value of the share. Yeah, this 10 rupees is face value of the share, and then this 1000 rupees is share capital, right? Now there are types of shares. Shares are divided into two types: equity share and preference share. First we're gonna discuss what is the difference between those two. So equity shares are like the owners of the company. They have right to vote, right? They can vote. Let's just say you want to start a new business, you want to expand your business. If you want to take any business decision, first equity shareholders have a right to vote. If all the equity shareholders agree, then you can expand your business or you can take any business decision. If they don't agree, then you cannot proceed with your business decision if they don't agree, because they are the owners of the company. They have right to vote. They will decide how you should conduct the business, right? And whereas preference shareholders, on the other hand, no voting right. They cannot vote. Probably you would have learned all this stuff in your 11th or 12th class. And right to dividend, and then rate of dividend. So first, they are like the owners of the company, right? So first, if there is any dividend, first they has to pay dividend to the preference shares. And then if there is any left out, then we have to pay to the equity shares. And then rate of dividend for them is a fixed rate. If you have promised 10% while issuing the preference share, then you will pay 10% exactly to them. But whereas for equity shareholders, there is no fixed rate. You may, if your profits are very high, and after distributing the dividend to the equity shareholders, still if your profits are very high, then you will get a high dividend rate. If your profits are very low after distributing the preference shareholders, then you will get a low dividend. It depends. So there is no fixed rate for them. But whereas for the preference shareholders, there is a fixed dividend rate. And another one is refund of capital. While liquidating the company or while closing your company, first you have to pay to the preference shareholders. If there is anything left, then only it will go to the equity shareholders, right? Let's just say this equity shareholder contributed, sorry, let's just say equity shareholder contributed 100 rupees. The preference shareholder also contributed 100 rupees. But company has only 50 rupees to distribute. Then this 50 rupees will be given to the only preference shareholders. If there is nothing left, then equity shareholder has to bear the loss because he is the owner, right? First, refund of the capital first while winding up the company. So first, the capital should be repaid to the preference shareholders. If there is anything left, then only equity shareholders, they will pay to the equity shareholders. So refund of capital while winding up the company, first preference will be given to the preference shareholders. And while paying the dividend, first preference will be given to the preference shareholders, right? So they will get a preferential right on two things, while paying the dividends or over the repayment of the capital, right? Preference shareholder will get preferential right, and equity shareholder has one thing, which is right to vote. And then redemption. Equity shares are not redeemable. That means if the company wants to give back their money, let's just say company took 100 rupees from the equity shareholders. If the company wants to give back to the money, then it will give. Otherwise, it's not necessary to pay back this money. But whereas preference shareholders, the company has to redeem the uh, preference shareholders. That means if the company took 100 rupees, company cannot keep this 100 rupees more than 20 years. They has to pay back to the preference shareholders within the 20 years. Right? Preference shareholders are always redeemable. Now, there are types in there. Let's discuss on those types. Shares, like just now we discussed, it is classified into equity shares and as well as preference shares. Preference shares again has classified into three types: on the basis of dividend, on the basis of participation, on the basis of convertibility. First, cumulative preference shares. Cumulative preference shares, let's just say in 2019, you got profits. In 2020 you got loss, right? So let's take the 2020. In 2020 you got loss. You can pay dividend to them only if you get a profit, right? If you get a loss, you can't pay dividend. So you just need to pay 10% dividend, right? In 2020 you didn't pay it. In 2021 you got profit. Then if they are cumulative preference shares, their dividend will be accumulated to the next year, right? So in this year you need to pay 2020 dividend as well as 2021 dividend in the, if it is a cumulative preference shares. That means in any year if you miss paying the dividend, that dividend will be cumulated to the next year. In the next year you have to pay that. But whereas non-cumulative, it is just opposite. If you didn't pay this year, then that year dividend is gone. In the next year you have to pay only to the next year dividend, right? Okay. On the basis of participation, participating preference share, they have a right to participate in this surplus of profits, right? So generally 100 rupees you got profit, right? And then we have promised 10 percentage to the preference shareholders. That means 100 into 10 percentage, 10 rupees we will pay to the preference shareholders. Remaining 90 rupees will be enjoyed by the equity shareholders only. If they get a loss, obviously equity shareholders only has to bear the loss, right? But some preference shareholders, if you are the participating preference shareholders, then you can participate in this 90 rupees also, to the extent, whatever the extent, to some portion of extent, whatever they have discussed while issuing the shares, to some extent they can participate in this surplus of profits also. Apart from this dividend, they can participate in surplus of profit also. Non-participating preferences, just opposite to that, they cannot participate in this. And then on the basis of the convertibility, preference shares can convert into equity shares. After a while it can convert into equity shares, that is convertible preference shares. If it is non-convertible preference share, you cannot convert into equity shareholders. Now we have discussed types of shares. Now we will discuss types of share capital. Authorized capital. In MOA, Memorandum of Association, right? In Memorandum of Association, let's just say you have authorized to issue 200 crores of the capital. That means you cannot raise money from the public more than 200 crores. Right? So that is authorized capital. 200 crores is the authorized capital. Obviously you don't need all the money at once. You have issued 100 crores of worth to the, you have issued 100 crores of capital to the public. Now even though you have issued 100 crores of worth, it depends. People, if the people like your idea, if the people like your company, they may subscribe all 100 crores, or they may subscribe less than that. Let's just say they subscribed only 80 crores, right? That means you want 100 crores, but the people agree to pay to you only 80 crores. That is subscribed capital, and then called up capital. And that 80 crores you don't want at once, right? You'll call in installments. Let's just say you want in the beginning stage of your company is only 40 crores. That is called up capital. You have called the public that you want 40 crores right now, but they have paid only 35 crores. That means remaining 5 crores defaulted the payment, right? So that is payment paid up capital. This 35 crores is the money you actually received out of all these things. Uncalled up capital means, so here 80 crores is the subscribed capital, right? Out of subscribed capital you called only 40 crores. So remaining 40 crores is uncalled capital. So authorized capital is the capital which is specified in our MOA. You cannot raise the money public more than 200 crores, right? Authorized capital, you can also call it as registered capital or nominal capital. And then out of that, you have issued shares to the public worth of 100 crores, that is issued capital. And then they subscribed only 80 crores, and then you called again in the subscription capital, you called again only 40 crores, that is called up capital, and the remaining is uncalled up capital. And then they paid at last only 35 crores, that is paid up capital, right? Okay. Now shares can be issued at for cash or for consideration other than cash. Let's just say company wants to buy a machinery worth of 10 lakhs, and then instead of paying 10 lakhs to them, they can issue shares. So that is nothing but for consideration other than cash. And then shares can be issued at par, premium, discount, right? So first par, the face value of the share is 10 rupees, and then if they issue the shares at 10 rupees, then they issued at par if it is equal to the face value. Then if the face value is 10 rupees, then they issued at 15 rupees. That means they issued at 5 rupees premium, right? And then discount, if they issue at 8 rupees, less than the face value, equal to the face value, par, more than the face value, premium, less than the face value, discount. But as per section 53, no company can issue shares at discount, right? Now we need to pass a general entries, we need to maintain accounts. Since discount is not required, we need to maintain the books of accounts for this. What are the general entries you will pass when you issue shares at a par or when you issue shares at premium? That you're going to discuss in the next part.